Welcome back to Invest Global. This is one of the most important videos I've recorded in a long time. It's going to be focused on inflation, the overall macroeconomy, and really helping you keep the finger on the pulse of what is going on using some indicators that I absolutely love. I always like to look at the US dollar index. Being the global reserve currency, it's very, very important to look at what the Dixie is doing, the DXY. So we will be taking a look at that, as well as the 10-year Treasury yield. Also with the Federal Reserve meeting, all these things together, what I want to discuss is inflation. Now, basically what the Federal Reserve said at that meeting was, hey, we're not going to change these interest rates, right? We potentially will do this in 2023, so you can't expect that, but currently they are not doing anything to fix the situation. And what you need to look at historically is these different cycles where we've seen either transitory inflation based on rate of change terms versus transitory in real rates. Okay, so rate of change versus absolute. Okay, those are the two different ones you need to look at. With absolute terms, what you see is you see temporary supply shocks. So, like, let's say in the 40s, it was labor and commodities. Those are the two main things where you had a supply shock in those. Currently in 2021 and 2020, what did we see? Well, we saw shortages in semiconductors, so actually making new cars. And where did you see this effect? Typically, it's not what most people would think, right? So it doesn't affect necessarily the new cars. But what do you see happening with used cars? The used cars market is crazy, right? You go to ask any used car dealership in the US, Canada, Australia, it doesn't matter where you're at. Used cars are going for premiums right now. And this is because of the semiconductor shortage. This is still something that we're kind of dealing with. But again, in these market cycles, essentially what you see, like I said, in the 40s, you saw this with labor and commodities. So short term, labor and commodities were in the shortage. And that was in absolute terms. So absolute terms versus rate of change terms. So with absolute terms, with transitory inflation, it's very important to understand that what you see is a temporary supply shock. So inflation increases. Essentially, your purchasing power decreases. The actual amount of goods and services you can buy with the same amount of capital that you currently have decreases. So you can have over seven figures, but guess what? That same seven figures isn't worth as much as it was a little bit ago. And it's crazy to see these things. So essentially, with absolute terms, essentially what you see is inflation spikes. We see a little bit of a plateau, and then it returns back to normal because goods and services kind of return to that balance. But in rate of change terms, this is where essentially you see inflation spike and you plateau, and that's basically we're forming a new level. So these are very important things to understand. So again, breaking this down, just on understanding that, okay, 40s we saw this happen, 70s we saw it happening with the oil embargoes, and this year, I don't know what that was, this car here in Batumi, Georgia is squeaking a little bit. But in 2021, we're seeing this with semiconductors. So you really see these problems with supply chains, right? And when you're not able to increase the actual supply of goods and services as broad money supply increases, that's where you see this rate of change term happening. And I personally think, maybe what we saw in, the 40s was a bit more of like in absolute terms of inflation. So we kind of peaked up, then popped back down. But here it's the rate of change, right? So the rate of change is increasing. And remember, it's transitory, right? So with this, I mean, we're seeing this increase in broad money supply. The Federal Reserve, the Treasury, I have a video on this talking about how they essentially, they're issuing new debts and then they're buying it up themselves. This is what's going on currently in the situation. And since they didn't raise interest rates, it's a massive, massive problem. So little rants over, again, just to recap those things, thinking about transitory inflation, rate of change versus absolute terms. So absolute is where it spikes up, returns back down. Rate of change is where it spikes up, plateaus, and basically stays there. That's our new normal, right? So people say new normal is terms of society. Man, that squeaky car, I apologize. But essentially, this is what's going on. So it's very important to understand these two differences and understanding that, okay, these things are going to happen long term. Whether or not you understand how these things work or not doesn't matter. It's going to affect everyone, right? Especially because the US dollar is the global reserve currency. Everyone basically has to use it as a peg for denominating assets in. And when you see all-time highs in the NASDAQ, all-time highs in these different indices, when I was back in Istanbul, Turkey, I remember it was every week we were seeing new all-time highs in all these different indices. And it's like, okay, you look at that, and then you look at people are more in debt. The nations are more over-leveraged. You look at GDP, you look at debt to GDP on the U.S.'s balance sheet. It's insane. We have never been in a time in history like this. So kind of crazy rants. I apologize, but we're living through pretty crazy times. So it's important to understand how these things work and then go, okay, what can I do about it? How can I fix this? And what I look for is inflation hedge assets. I look for, okay, how can I basically be my own bank, right? I look for things like emerging market equities. I look at things like real estate. I look at commodities. Commodities are incredibly undervalued right now. You look at gold. As the NASDAQ has increased in the actual dollar, obviously since here back in March of March 20. We basically have fallen. We're in this kind of descending wedge right here, kind of bottomed out at these levels right around that 89 mark. And now we've just pumped up, right? And it's like, okay, this happened. This pump right here was after that Federal Reserve meeting. You see that massive parabola right here, right? So you see this massive move towards the upside. That was after the Federal Reserve meeting. We were kind of trying to decide what was going to happen here, right? Just a bit of consolidation, minor pump up here because people anticipated a little bit. And then once that news hit, boom, we've been in this massive spike. Now, I do think we will see a decline. So what does this mean? Well, as the U.S. dollar, typically this is how I look at the Dixie, right? Just as kind of a basic indicator is as the U.S. dollar is decreasing in value, that is overall stock market positive. As crude oil increases, so as you look at the crude oil chart, as crude oil increases, that's also stock market positive, right? So as when typically when the U.S. dollar is rising, that's somewhat stock market negative. But guess what? I mean, you look at the monthly chart in the Nasdaq, all-time highs. This little dip we saw back here in March, right, of the Corona dip or whatever you want to call it, where people sold off a ridiculous amount. I purchased a nice amount there, then I sold it off right here. Or no, it was actually back here in was it July? I sold off a decent amount of I picked up some equities that I knew just people basically panic sold. What I've held long term as far as U.S. equities is commodity producers, so things like gold mining stocks, silver mining stocks. Then as far as global equities go, I really like uranium producers. I really like copper. I really like lithium right now. All these things very important in 5G and electric vehicle plays. But you get the point, right? So we're seeing this disconnect. You see a disconnect from the actual, you could say the actual economy. So you ask your neighbor, okay, hey, obviously most people don't talk about these things, but you see how much debt they have to issue. You see they're taking on a new car lease, they're getting a new mortgage. And honestly, if you can get a fixed rate 30-year mortgage at 2.2% or something like that right now, hey, I think it's an interesting opportunity. Obviously, consult your financial advisor, but you're basically hedging against that, right? So you're using debt in this case with interest rates haven't rose. Let's say the Federal Reserve would have said they rose, then I think we would have gone. The U.S. dollar would have continued to see a fall. But at any point in time, they can change these things. So just because they announced at this meeting that they're not going to do it till 2023, doesn't mean that, hey, tomorrow they can't come out and do these things. They have to do something about inflation, right? So then you look at, okay, where are the opportunities in the market, especially with the 10-year yield kind of fall here while the U.S. dollar is increasing. What does this mean when the 10-year yield is falling? That means there's a little bit of fear. There's a little bit of panic in the market because people are not sure where to go, right? You look at the 10-year Treasury yield, typically when it's just kind of steady across the board, that is overall equity positive, right? So that's kind of stock market positive. Again, as that crude oil increases, typically that is also stock market positive. U.S. dollar going down, that is stock market positive as well. So all these indicators, then you inverse them, you see stock market negative. But again, it's this disconnect from markets in the economy. You see people are more in debt than ever. People are more leveraged than ever. As I talked about, debt to GDP in the U.S. is insane. So, sorry about that. We go here to the gold chart, and we look at, okay, what is happening here with gold? Well, gold took a massive fall. This is where I think precious metals like gold are very, very interesting because people really only get into these things when it's too late. People get into gold in these super cycles. Let's just zoom out and go to the monthly chart, right? We look at these past cycles with gold, and what ends up happening is people have panic when they see inflation. Then they go into gold. I like to be in these things early, and especially gold producers. Like I said, a lot of commodity producers are ridiculously undervalued right now, in my opinion. Obviously, not financial advice, but hey, do your own research. Take a look at these things. When these things happen, these are kind of these. How would you say it? These are kind of inflationary cycles where people panic. You could say this was the oil embargo time. If you look at the 40s, you can't really see it on this chart, right? But there was a spike here, just like with Bitcoin. You look at these past bull runs and they look like nothing on the chart now. But this massive spike here, same thing. You saw it in of 12, so of 02. And then we saw this kind of massive run up, and now we've retraced a bit back down. But basically, people go into these equities when it's too late. They kind of fear buy. They go, okay, I need a store of value. Maybe I have a house. Maybe I have stocks. But once you see that stock market crash, where does the money flow? Well, are people going to keep their money in something that's really melting away, being the U.S. dollar? Are they going to hide cash under their bed? No. You want to be, at least if they're smart about it, right? So the sad thing here is typically what inflation does is actually hurts the bottom 50%, the people that don't understand how these things work, and it helps the people who are in assets. So if you are in assets and we see this inflation, that's where you see prices increase. That's where I think you can see it in the NASDAQ. I think you can literally see inflation in the NASDAQ. And I think you can also see it in the US dollar index. You can see it in crude oil. You can see it in the 10-year yield. And you can see it in commodities. Now, The commodities that are not catching up with this are silver and gold, and that's where I think there are opportunities. Copper's been on this crazy run. Uranium's been on a pretty nice run. I've got a lot of the nice upside there. Obviously, when crude oil went pretty negative, I picked up some crude oil, and that was a nice opportunity. But what hasn't ran, right? So lumber even ran. A lot of these housing commodities have ran. I've done videos on those. But yeah, I mean, I don't want to make this video too long, but I want you to understand all these different factors when it comes to inflation, and just the fact that if you need someone to tell you that inflation is happening and you don't see it in front of your eyes, hey, maybe go get a 9-to-5 job and try and get by. But I personally think, as far as capital preservation and capital really gain, you need to be looking at these things. You need to understand, like I said, rate of change terms versus absolute terms, how these things work dynamically. And I personally think we're in the situation where we're going to see rate of change terms with inflation. We will see the spike, this plateau, and I think that's going to be kind of the new normal, because you can't put the cat back in the bag, right? Either you can increase taxes, either you can increase interest rates. But hey, I mean, we see this continued increase in taxes. That's why I'm always in a different market. That's why I love here, beautiful Georgia. I mean, Batumi Bay on the Black Sea, it's absolutely incredible. Low taxes. There's tons of opportunities around the world. Travel more, invest more. Look into emerging markets, look into frontier markets. That's basically all for this video. I discuss all these different things on the channel, so I know it was a lot for today's video, but basically going to end it out. Thank you very much for watching. Let me know if you have any questions at all in the comments. If you have any concerns, I'm always open to iterate and improve how I view things. So join the Telegram group, link down below. Send me, message me on Twitter at investglobal_IO. I typically check that every other day, something like that. But in the Telegram group, we're a bit more active, also in the comments. But if you enjoyed the video, hit the like button, subscribe to the channel to stay up to date, hit the notification bell and all, so you don't miss out on a new video. You don't want to be watching this in a 2023 when we've already seen this a real rate of change, inflation. And the main thing is positioning yourself so you benefit either way, right? So if you understand how these things work, you can do that. And that's basically, like I said, all for this video. Again, if you enjoyed it, like, subscribe button all, Invest Global, and until next time.